For years, the dominant assumption was that the United States held an unchallenged lead in artificial intelligence. That belief was built on America's leadership in advanced AI companies, cutting-edge semiconductor technology, and enormous private investment. However, a series of recent AI releases from Chinese technology firms has forced investors, policymakers, and industry experts to reconsider that narrative. The significance of these developments extends far beyond benchmark scores or chatbot performance. They suggest that China's AI ecosystem has matured far more quickly than many observers expected. Instead of relying solely on larger computing budgets, Chinese companies have demonstrated an increasing ability to improve efficiency, reduce operating costs, and optimize existing hardware. These achievements challenge the long-held assumption that access to the most advanced chips alone determines AI leadership. More importantly, the conversation is shifting from individual AI models to the broader foundations of technological competitiveness. Artificial intelligence depends not only on powerful semiconductors, but also on software engineering, industrial manufacturing, energy infrastructure, research talent, and long-term investment. Evaluating only one component provides an incomplete picture. The latest Chinese advances have highlighted that AI leadership is ultimately determined by the strength of an entire innovation ecosystem, not by a single technological advantage. Artificial intelligence is often judged by the performance of chatbots or language models, but those products represent only one part of a much larger ecosystem. True AI leadership depends on four interconnected pillars: software development, advanced hardware, semiconductor manufacturing, and affordable energy. Weakness in any one of these areas can limit the performance of the entire system. Software provides the intelligence behind AI models, while hardware delivers the computing power needed for training and deployment. Semiconductor manufacturing determines access to high-performance chips, and energy infrastructure influences how efficiently AI systems can operate at scale. Together, these elements shape both the cost and speed of innovation. This broader perspective explains why measuring leadership by advanced chips alone can be misleading. A country may trail in one category while outperforming in others that ultimately determine commercial success. In today's AI race, long-term competitiveness depends on building a balanced ecosystem where technology, manufacturing, infrastructure, and energy work together rather than relying on a single advantage. The competition between the United States and China is not simply a contest between technology companies. It is a comparison of two very different innovation models. In the United States, much of the AI industry is driven by private investors and venture capital firms seeking rapid growth and strong financial returns. In contrast, China combines private enterprise with long-term government planning, allowing strategic industries to receive sustained financial support over many years. These contrasting approaches shape how businesses develop new technologies. American startups often focus on attracting investment and expanding quickly, while Chinese firms typically operate within a broader industrial strategy that emphasizes manufacturing capacity, infrastructure, and technological self-reliance. Both systems have strengths, but they reward different priorities. As AI becomes increasingly important to economic growth, the key question is no longer which country produces the most impressive model. Instead, it is which innovation system can consistently transform research into scalable industries, maintain investment over the long term, and adapt to future technological challenges. One of the defining features of America's technology sector is its venture capital ecosystem. While it has helped launch many successful companies, its primary objective is often to maximize investor returns rather than build sustainable businesses. Startups are encouraged to grow rapidly, attract higher valuations, and secure additional funding rounds before eventually providing profitable exits for early investors through acquisitions or public listings. This structure creates incentives that reward speed over stability. Companies frequently prioritize market expansion and investor expectations, even if profitability remains years away. In AI, this has fueled massive investment into promising technologies, but it has also increased pressure to justify ever higher valuations. While this approach can accelerate innovation, it also introduces financial risk. If investment slows or the market expectations change, companies built on future promises, rather than current earnings, may face significant challenges. The result is an innovation system where financial momentum can become just as important as technological progress. China has adopted a different path for developing strategic technologies. Instead of relying primarily on private venture capital, it combines state-backed financing, policy guidance, and long-term industrial planning. This approach directs capital towards sectors considered essential for future economic growth, including artificial intelligence, semiconductor manufacturing, and advanced infrastructure. Because much of this financing is designed with longer investment horizons, companies often have greater flexibility to pursue complex research and industrial expansion without facing constant pressure for immediate financial returns. The focus extends beyond individual startups to strengthening entire supply chains and manufacturing capabilities. Whether this model ultimately proves superior remains open to debate. However, its emphasis on long-term planning demonstrates that technological leadership is influenced not only by innovation itself, but also by how nations choose to finance and support that innovation over decades. American financial markets have generated enormous wealth over the past 2 decades, but that success has become increasingly concentrated in a relatively small number of companies and investors. As technology giants grow larger, their influence on stock market performance continues to expand, making overall market gains increasingly dependent on a handful of firms. This concentration raises important economic questions. Rising stock prices do not always reflect improvements in productivity or living standards. Instead, financial gains may become disconnected from the broader economy, while many households continue to face rising living costs and growing financial pressure. For AI, this matters because investment decisions are closely tied to financial markets. If market expectations shift or technology valuations decline sharply, funding for ambitious AI projects could also become more difficult, potentially slowing innovation despite continued technological potential. Technology leadership depends on more than funding and infrastructure. It also requires a steady pipeline of highly skilled engineers, researchers, and scientists capable of developing the next generation of innovations. Human capital remains one of the most important competitive advantages in the global AI race. China has spent decades expanding higher education, technical training, and research capacity, producing large numbers of graduates in engineering and STEM disciplines. Meanwhile, the United States continues to benefit from world-class universities and research institutions, but faces ongoing debates about workforce development, education quality, and access to technical talent. As AI technologies become more complex, the countries that consistently develop skilled professionals will be better positioned to sustain innovation. In the long run, investment in people may prove just as valuable as investment in computing power. Despite rapid progress elsewhere, advanced semiconductor technology remains one of America's strongest competitive advantages. The design and production of cutting-edge chips continue to play a critical role in training powerful AI models and supporting high-performance computing. This remains one of the few areas where the United States maintains a widely recognized technological lead. However, China has accelerated efforts to reduce its dependence on foreign chip technology through domestic research, manufacturing investment, and alternative engineering approaches. Even where immediate parity remains difficult, improvements in efficiency and system optimization can narrow the practical performance gap. The future of semiconductor competition will likely shape the next phase of the AI race. If China continues closing the gap while strengthening other parts of its AI ecosystem, the balance of technological leadership could become increasingly competitive over the coming years. The global AI race is no longer defined by a single breakthrough model or one company's latest announcement. It is increasingly a competition between entire economic systems, each combining diverse technology, finance, manufacturing, education, and energy in different ways. Looking only at individual products provides an incomplete understanding of where the real advantages lie. As both the United States and China continue investing heavily in artificial intelligence, the outcome will depend on which country can sustain innovation over the long term while adapting to changing economic realities. Success will require more than faster processors or larger AI models. It will demand resilient institutions, efficient infrastructure, skilled talent, and smart investment strategies. In the years ahead, the winners of the AI era may ultimately be determined not by headlines, but by the strength of the systems supporting innovation behind the scenes.